Welcome back friends, welcome to the channel JAIIB and CIB Made Simple. So this is our 10 minutes miracle series part number 3 lecture. Already I have provided you 2 lecture on unit 29 and 31 in which I have revised the entire concept in just 10 minutes. So get ready for unit 31. For next 10 minutes I will revise you entire concept, all important points in the lucid manner. And if you want PDF of this, you can enroll in our IE&IFS capsule program. So let's begin with the chapter name is Capital Market and Stock Exchange. So first thing is regarding the capital market. So think of capital market as a bridge. It turns saving into investment and which helps the economy grow. Entrepreneurs use this money for their business. Borrowing impact how much profit they can make. Now let's talk about the secondary market. This is where previously issued stock and bonds are traded. It is divided into two parts. One is called auction market, like a stock exchange where buyer and seller meet. Second is dealer market. This is called OTC market where the trades are made directly between the parties. The third thing is function. So function of the secondary market. So it helps set prices for the security and monitoring management. So it keeps an eye on how companies are running. It encourages better management and decision. Next is bank role. So bank help by managing account, offering credit and ensuring transaction go smoothly. Now let's talk about capital sourcing and regulation. Company raises capital through equity share, debenture and bonds. The market is regulated by the SEBI, Security Exchange Board of India, ensuring rules are followed. This market mainly deals with long-term debt and the equity market. Let's talk about the primary market. So primary market is where company raise capital by selling new security either through public share or through private placement. Merchant banker and issue manager help companies through the process. Now bank role, they help as like an arranger, underwriter and manage the bank in the process of issuing share. Now let's talk about stock exchange in India. So the India has 4 stock exchanges. First is BSE, that is called Bombay Stock Exchange. The oldest started in 1875 and was the first recognized by the SEBI. Next is NSE, a National Stock Exchange, established in 1992 and is permanently recognized by SEBI. Next is CSE, Calcutta Stock Exchange, established 1908 but is currently inactive although SEBI recognized. And the last is Metropolitan Stock Exchange, established in 2012 and it started trading in 2013. Now let's move on to the next slide. Let's talk about the demutualization of this stock exchange. What is this all about, this demutualization? It means stock exchanges are separated into ownership management and trading right. Okay, this is called demutualization. For example, exchange like BSE and NSE have undergone this process. Now brokers trade on official system like BSE and NSE. Sub brokers, this question was asked last time. Okay, the broker trades on recognized system like NSE and BSE. Sub broker, they work under the broker and must be registered with SEBI. Depository hold your share in electronic form. No physical paper, just digital record. Depository criteria. Examples in India, there are 2 examples, NSDL and CDSL. And CDSL. Now let's talk about the financial product in the stock market. So depository criteria is that he must be registered with the Companies Act 1956. Now let's talk about the financial product in the stock market. The first thing is called equity, right? You can see depository in India. Now let's talk about this CDSL 16 numeric data, NDSL 2 alpha plus 4 numeric data. Now financial product in the stock market, equity means owning a piece of the company, that is called equity. Common in 2 form. The first is common and preference share. Preference share get fixed dividend but no voting right, while common share might come with more risk and voting right. So these are the features. Now right issue, when a company offer more share to existing shareholder, that is called right issue. What is bonus share? If free share from the company profit, that is called bonus share. Now let's talk about the preference share. Preference share in the fixed dividend, no voting, priority in liquidation, right? And redeemable share, tenure is less than 20 years. And the second is cumulative share. So if we talk about the cumulative share, then we have unpaid dividend accumulate, cumulative convertible share, it can be converted to equity after a set date, and participating share in extra profit after fixed dividend. Now let's talk about the key instrument in the capital market. The first is security receipt. It is issued by the financial firm to big buyer usually to recover bad loans. Next is GSEC, government security. It is bond issued by RBI on the behalf of the government with interest payment. Now let's talk about the debenture. Debenture is the company version of a bond offering fixed interest paid twice a year with the principal amount returned on redemption. These are the features of debenture. Let's talk about the bond. Bond are general debt certificate that also pay interest periodically and are fully repaid at maturity. Now T+1 trade settlement SEBI proposal. So what is T+1? T+1 means trade settlement will be completed in 24 hours instead of currently 48 hours, right? T+2 means 48 hours. Why does it matter? Because it offers less risk for investor and faster payment. Now it offer more liquidity for big investor, and the retail investor are not affected much, but everyone gets their money faster. What are the challenges? The challenges is that it need careful planning and changes to the market system. That's why shifting from T+2 to T+1 matters a lot. Now what are the type of capital issues? The first is IPO, when a company sell its share for the first time. The next is FPO, a listed company offer a new existing share. Next is right issue, when a company give existing shareholder a chance to buy more share, that is called right issue. Next is private placement, share sold to a small group of investor, that is called private placement. Next is QIP. QIP is a special type of private placement only for institutional buyers. So remember these things, very important from examination point of view. So we have discussed T+1 trade settlement, right? Now let's talk about the SEBI eligibility. SEBI eligibility norms for capital issue. First thing is public issue. SEBI, for public issue, SEBI norms are mandatory. For right or preferential issue, no any SEBI norms required. For QIP, only for listed company with public share on NSE and BSE, SEBI norms are required. Now let's talk about the documents, key documents. What is the key document? Public issue. Public issue, a draft prospectus is submitted to SEBI. Next is right issue. Right issue over 50 lakh rupees. A draft letter is filled with the SEBI. Preferential or QIP, no offer document is required. If you talk about merchant banker, make sure everything follow the rules, and the offer document with an investment detail is open for public company for 21 days, right? So offer document for public company, public comments is open for 21 days. What is DHRP? This question was asked last time. RHP, no price number, price band released via ad, and book building, discover price, final price in ROC prospectus. DHRP is submitted to SEBI for public share offering. For public share offering, this DHRP is submitted to SEBI. It includes business information, financial risk, how the company will use the capital, and the industry overview. Next is about the financial information. This financial section help investor gauge whether the company is safe and profitable investment. Let's talk about risk factor. The document also cover legal risk and industry trend. What about the IPO pricing? Let's move to the next slide. See, IPO pricing, if we talk about the pricing since 1992, so IPO pricing, the key criteria is free pricing. What does it mean? It means that companies and merchant bankers set the price, SEBI don't control it, right? Issue types. The first is called fixed price. The price is set beforehand, and the second is called big building. It means it is the price discovered through bids. Now next topic is allotment in big build issue. If we are voluntary big build, then 35% for retail investor RII, 15% for non-institutional investor NII, and 50% for QIB, including 5% reserve for mutual fund. If we talk about the compulsory big build, then 75% goes to QIB, 15% to NII, and 10% to RII. So that's your quick guide to SEBI norms, IPO pricing, and share allotment. Now let's talk about the investment categories in the next slide. So first thing is RII, that means retail investor. So people who invest up to 2 lakh in an IPO, that is called retail investor. Next is QIB. QIB is qualified institutional buyer. Okay, these are large SEBI approved institutions like mutual fund. Next is NII. NII is non-institutional investor. It includes high net worth individuals and corporates. Next is anchor investor, large QIB who invest 10 crore or more in an IPO. Now there are some key IPO terms to know. What are the key IPO terms to know? The first thing is called green shoe option. Extra share are issued to keep the share price stable after an IPO. So after an IPO, some extra share are issued to stabilize post listing price. SCSB, that is self-certified syndicate bank. So bank that offer the ASBA. ASBM is application supported by block amount, meaning your IPO investment is blocked but not debited until the share are allotted. Next is IPO eligibility condition. First thing is that to launch an IPO, companies must meet certain requirement. First is net tangible asset of at least 3 crore over the last 3 years, average operating profit of 15 crore, net worth of 1 crore for the last 3 years. If we talk about fixed price issue, in fixed price IPO, the 15% of the 50% of the offer is reserved for the retail investor who invest up to 2 lakh. We know already I have told you investor apply for less than 2 lakh, and institutional investor like QIB and non-QIB also gets a portion, with the anchor investor putting in large sum greater than 10 crore. Already we have discussed. Let's talk about the alternate IPO routes. So if a company does not meet all eligibility criteria, they can still go for an IPO through a book building process, right, where 75% is reserved for QIB, and after the issue they must meet NSE listing list. That's the point. Now so that's a quick rundown of the investor category and the IPO basic. Now let's talk about the IPO pricing method. So pricing, I think we have covered it. Free pricing, voluntary book build, NSE eligibility list. Okay, so see, since 1992 there is a free pricing in IPO, right? Already I have told you there is a free pricing in IPO, means company and merchant banker decide the price without SEBI formula. And there are two type of pricing. Fixed pricing means the price is set up front, and book building means price is determined through bids from investor. Now if we talk about the share allotment, so share allotment in the voluntary book build, 35% goes to RII, 15% to NII, and I think it is repeated once, right? Now let's talk about the NSE listing criteria. To be listed on NSE, company needs 10 crore post issue paid up capital and a total equity capitalization of at least 25 crore. What is ASBA? ASBA stand for application supported by blocked amount. So it is a feature of the retail investor. For retail investor, it blocks the amount in your bank account until the share are allotted. To apply, you provide details like your name, PAN, demat account number, and bid price. Now what is this safety net scheme? So let's discuss this safety net scheme. This is here. So this safety net scheme is that this scheme protect original retail allottee for up to 1000 share. It protect original retail allottee forever 1000 share, and it is valid for 6 months from the time share are dispatched. Two things you have to remember regarding this safety net scheme. So that's your quick guide to the entire topic. Now let's do some MCQs to make our conceptual clarity. The question is, which of the following statement accurately summarize the roles and functions of the capital market, secondary market, capital sources, primary market, and stock exchange in India? See, very good question it is. Let's go through the first option. The first option says that the capital market plays a crucial role by converting saving into investment. Correct? Right, this is where saving are turned into investment. Supporting entrepreneur raising capital. Correct. Although the borrowing may impact their profitability, yes, but borrowing might affect their profits. The next thing, secondary market trades previously issued equity and debt security. Yes, this is in the secondary market, existing shares and bonds are traded, and it facilitates price discovery. Correct. It helps in discovering the right price, the secondary market, and it enables company control through monitoring, management, and incentive. Correct. It helps in discovering the right price, and it also allow investor to monitor company by checking how they are managed. And bank also play a vital role in facilitating transaction, right, by handling transaction and managing risk. So this option is correct. Option B says the primary market is responsible for raising capital through methods like public issue and private placement. Yes, it is correct, because in primary market, company raise new capital through IPO or private placement, where intermediary like merchant banker and bank finance the process. Next is a stock market. In the stock exchange, India has multiple stock exchange, like you can see BSE, NSE, CSE, metropolitan stock exchange. So this option is also correct. So the correct answer is all of the above. All of the above options are correct in this particular question. Let's move on to the next question. Next question is, which of the following accurately summarizes the demutualization of stock exchange and the role of depository and the financial product in the secondary market? Option A says demutualization of the stock exchange separate ownership, management, and trading right, as seen in the demutualized exchange like BSE, NSE, and OTCI. Correct. It separate ownership and management. Example include BSE, NSE. Now the broker trade on recognized system and sub broker on SEBI registered system. Actually it is correct. Now the depositories institutions like NDSL, NSDL, and CDSL hold security electronically. They boost liquidity, reduce settlement risk, and maintain accurate record of ownership. And the next thing come regarding the financial product in the secondary market. So depository, I have told you it is correct. Now financial product in the secondary market, investor can buy and sell equity share. Already we have discussed. Common share carry voting right and risk, while preferred share offer fixed dividend but no voting right. In the preferred share you have fixed dividend but no voting right. Other instrument include bonds and debenture. Right. So all of the above are correct here. Now let's move on to the next question. Which of the following statement accurately encompass the characteristics of preferred share, other instrument in capital market, T+1 settlement, and type of capital issue. First option say preferred share comes in the various form. Yes, it comes in the cumulative, where unpaid dividend are carried over. Cumulative convertible, where it can be changed into common share after a set date. Participating means share in extra profit after getting a fixed dividend. Next is other capital market instrument include security receipt. Correct. It is issued by firm to recover bad loan. Government security, these are the bond issued by the RBI for the government. Debenture, company issued bond with fixed interest rate. Now let's talk about option C, the T+1 settlement. SEBI is moving to a T+1 settlement, which means settlement will happen in 24 hours or instead of 48 hours. Right, T+1 to T+2. This helps speed up the transaction, reducing risk and boost liquidity for big investor. However, it requires careful planning to work smoothly. Option D says type of capital issue. The first is called IPO. The first time a company offers share to the public. The next is FPO. That means the listed company offer more share to the existing one. Next is right issue. That means company offering more share to their current shareholder. And the last is private placement, including QIP. So this is shares are sold to a small selected group of investors. So option E is the correct one. Let's move to the next question. Which of the following correctly outline the key feature of the preferred share, other instrument in the capital market, SEBI T+1 trade settlement, types of capital issue in the pricing market, SEBI eligibility norms, and DHRP, that is draft hearing red prospectus. So let's see the first option that we have. And the first option says that preferred share cumulative. I think we have discussed this thing, right? We have covered this, so it's again repeated. Yes, from here option number E we will see, that is DRHP. This is a crucial document that help investor understand the company business, financial situation, risk, and plan for the capital raise in IPO. Now let's talk about the last question of this session. Which of the following accurately summarize the key investor category, IPO terms, eligibility condition, and IPO process? Now the first thing is investor category. Investor category include RII, institutional investor, QIB, NII, and anchor investor. Right. So RII who's apply for total investment amount of 2 lakh, QIB recognized by SEBI, NII which include high net worth individual, anchor investor that apply for minimum investment of 10 crore. Now other terms like green show option is an option that allow for the actual issuance of additional share to stabilize the stock pricing. And next is SCSB, which is self-certified syndicate bank. Right, ASBA means application supported by block amount. So where IPO funds are blocked until allocation, or it is crucial to the IPO process. Option C say IPO eligibility criteria. Company must be certain criteria such as net tangible asset must be at least 3 crore over last 3 years. And the next is average operational period must be 15 crore. Right. And the next is fixed price issue. These issue have a fixed determined price, and 50% of the share are allocated to the RII. That is called retail individual investor. Different investor type have limit on the amount they can apply for, like in the case of QIB, RII, and IPO alternative routes. Companies that do not meet the standard eligibility condition can still borrow with an IPO. Right. So friends, this is all about our particular lesson. If you want PDF of this particular session, please WhatsApp me on this particular number. I will provide you the PDF, and it is included in our IE&IFS capsule course. The link of capsule course is provided in the description section. If you really find the content useful, then please hit the like button. Thank you.